Identifying financial red flags in your business. Introduction. Recap of the key takeaways from Day 1, the basics of forensic accounting and its importance in detecting financial discrepancies. In Day 2, we take a look at identifying financial red flags that could indicate potential issues within a business. The goal of this session is to equip you, the business owner or manager, with the knowledge to recognize warning signs early. What are the financial red flags? Indicators or warning signs that something may be wrong with a company's financial records. The significance red flags can signal potential fraud, errors, or operational inefficiencies that could harm the business. It is important to identify these red flags early to prevent small issues from becoming major problems. Key areas to monitor. The key specific areas amongst many where financial red flags are most likely to appear: revenue inconsistencies, sudden drops in revenue, unrecorded sales, or discrepancies between sales records and deposits. Expense irregularities, unexplained increases in expenses, duplicate payments, or expenses that do not align with the business's operations. Inventory discrepancies, shrinkage, mismatches between physical inventory and recorded amounts, or unusual inventory adjustments. Discuss the potential impact of ignoring these areas: financial losses, reduced profitability, and increased risk of fraud. Areas to look out for. Highlight are some additional areas where red flags might emerge. Patterns and transaction timings. Look for spikes in transactions at the end of the month or other unusual timing patterns. Unusual vendor payments, payments to new or unknown vendors, especially if the amounts are significant. Inadequate documentation, missing receipts, invoices, or approval records for transactions. Encourage business owners to regularly review these areas to catch potential issues early. Case study introduction. Scenario: a revenue concern. ABC Services, owned by Mr. Smith, has been performing well with a steady stream of clients and consistent sales. However, while reviewing last month's financial reports, Mr. Smith notices something unusual. Revenue is significantly lower than expected, despite steady sales activity throughout the month. Perplexed by this discrepancy, Mr. Smith decides to dig deeper. He suspects that either some sales have not been properly recorded or there may be an issue with how transactions are being tracked. To get to the bottom of this, he reaches out to one of his employees responsible for managing sales data. Here is how a business owner might identify and address revenue discrepancies. Our revenue last month was lower than expected, even though sales seemed steady. Do you know why?
We had a few returns that weren't accounted for properly. I thought it would balance out.
Let's go through the sales and returns records to see where the issue is. Highlight the importance of following up on unexplained discrepancies and verifying records. Analyzing the discrepancy. Here are the steps that you should take to analyze the revenue discrepancy. Compare sales records with bank deposits. Ensure that all sales are accounted for and correctly deposited in the bank. Check for unrecorded returns or discounts. Review records to see if any returns or discounts were not properly recorded. Identify any missing transactions. Look for gaps in the sales records that could explain the discrepancy. There is always the need for thorough and regular reconciliation of sales and revenue. Strengthening internal controls. You need to have strong internal controls in preventing and detecting financial discrepancies. Daily sales reconciliation. Regularly compare sales records with bank deposits and inventory to catch issues early. Regular audits. Conduct periodic audits of financial records to ensure accuracy and compliance with internal controls. Segregation of duties. Ensure that no single employee has control over all aspects of a financial transaction, reducing the risk of fraud. Encourage businesses to implement these controls to safeguard their financial health. When to investigate further. Explain when a deeper investigation is necessary. Recurring discrepancies. If the same issues continue to appear, it may indicate a larger underlying problem. Lack of clear explanations. If discrepancies cannot be explained or resolved internally, it may be time to seek external help. Weak internal controls. If controls are found to be inadequate, a thorough investigation is needed to strengthen them. It is important to address these issues promptly to prevent further problems. Summary and takeaway. Recap the key points covered in the presentation, identifying red flags, understanding what financial red flags are and why they matter. Key areas to monitor, focusing on revenue, expenses, and inventory for potential issues. Strengthening controls, implementing strong internal controls to prevent and detect discrepancies. When to investigate, knowing when it's time to take a closer look or seek professional help. Encourage the audience to stay vigilant and proactive in managing their business finances. Let's connect, contact Peter Adams. Spot a red flag? We can help. If you've identified any red flags in your financials or need help reviewing your statements, reach out to Peter Adams. Our expert forensic accounting services can help you uncover and address any issues before they escalate. Stay informed and connected. If you are concerned about suspicious activities in your business, let's connect. You can book a complimentary 30-minute session at www.numberschef.co.uk. Follow us on social media and subscribe